Curious about maximizing your investments? Tune into our latest Money Mindset Mastery podcast episode. We dive into the value of financial advice and how it boosts your returns. Discover the benefits of behavioral coaching, customized family wealth planning, and tax strategies. Learn how these elements can transform your financial future and help you make informed decisions. Don't miss out on expert insights and practical tips. Listen now to understand the holistic approach to financial planning and why professional guidance is crucial. Click the link to start listening.
Well, I think we're live right now. So I'd like to welcome anyone who's watching or listening to the Money Mindset Mastery podcast. I'm your host, Jim, a little bit under the weather with a little bit of brain fog as well. So I'm going to do my best to get through this. But if I'm struggling, then my two co-hosts will step right in and take over. And speaking of my co-host, joining me today, as always, is Ryan Janot. Ryan, how are you today?
I'm good. I'm still debating that I should have put my Hawaiian shirt on because the weather is beautiful and that we're leading into a weekend of beautiful weather. So I probably should have fit the bill when it came to that. So, but
and you know what? I think actually, I think I would have loved to have seen a Hawaiian shirt on our next host as well, Denis Bazan from TVH Wealth Portfolio Manager. Denis, how are you today?
We're doing well and trying to avoid all these people here that are getting the bug. You're the third one I've heard this week.
Yeah, my daughter's been sick for about a few days now, and then last night going to bed, all of a sudden things went sideways for me, and I'm still kind of dealing with it. So I guess it is the season.
Mm-hmm. And I think Denis seems more like a Bermuda man more than a Hawaiian shirt guy. So
you think so? Yeah, you're right. Well, we'll have to do a session and
Hawaiian
see.
shirts and long socks.
Yeah. Now, in today's episode, we're not talking about any of those things. Excuse me. We're actually talking about a study or a report that Russell Investments they put out every year, and they are an investment company. And what they try to do is determine what the value of an advisor or advice brings to an individual's investment or portfolio. So we're going to go through that report. Funny enough, that rate of return has actually dropped slightly year over year. So we'll talk about why that might be the case as well. And keep in mind, this is rate of return above and beyond what your fees are and what your investment return is. So that's kind of what they've determined. They're not the only company that's done this report. I've seen it with other companies as well. But we're going to focus on Russell Investments' specific report that just came out. What I'd like everyone to know and understand is anything you hear today, do not take that as financial advice, investment advice. We're not making any recommendations in terms of the rates of returns you're going to hear. None of them are to be considered guaranteed. Out of the three of us, we don't sell Russell Investments either, so we don't have an affiliation with them. We're specifically going to be focusing on their report that just went out. So I think, Ryan, why don't you lead the way?
Yeah, so again, just like Russell, there's always a report to talk about how working with an advisor can help out. And I think some of the things that are most important that people forget about when not working with or working with an advisor is, I think one of the things is the portfolio, right? The ability to construct a portfolio and diversify that portfolio based on the person's needs. You know, often some of those things can be cost effective for the clients. I think one of the biggest things, again, you and I, Jim, talk a lot about is, you know, the emotional well-being and kind of peace of mind that can happen, because when there's uncertain times, people make, you know, emotional decisions. And I think that's one of the things that really separates working with an advisor or working with a coach or somebody that is trusted for you. And, you know, the other thing is just the overall holistic plan that can come together when putting together a plan with an advisor, because we don't just look at right now, we look at the longer term effects all the little points that happen within your life, whether it's starting a family, changing a job, all these things come into play. And these regular check-ins are the things that often I find have added the value for clients. Clients that don't work with advisors, I find, are just not getting any advice at all, and they're not being checked in. And there's a lot of institutions that are you're being charged the money, so why not accept the advice too with the proper advisor? So those are some of the things that, just as a snapshot that I found pulling from the article, and even with our own experiences. So,
well, let's share with people what it actually states in terms of the added rate of return that advice provides. So as of the 2023 report, it indicates here that it adds a 3.52% per year, in addition to, again, their regular rate of return. So if you're in an index type of investment or even a managed portfolio, having a professional advisor adds an additional 3.52% to your return. And that's down from, I believe it was 3.95%, correct, Denis?
I think so, yeah.
Yeah. So we're going to break down actually what makes up that 3.52%. So why don't we talk about the behavioral coaching, Denis, and let people know, out of that 3.52%, how much of that actually is behavioral coaching benefits, and what behavioral coaching is.
Yeah, well, the one thing I want to say, and I think it's true for most people, is when the market's up and everything's going fine, you're getting good returns, there's nobody complaining, nobody really wants to do anything, they're just enjoying it and taking the returns. Well, unfortunately, in reality, the market does not go straight up, and that's when you really got to help clients to think about the long term, not sell, not panic, move forward. When I sit down with a client, I really take their investments and we assign a time horizon. What is this money going to be used for? If it's education, obviously you want it. You don't want it high risk, because if the market goes down, there's no chance or no time for the assets to rebound. So what you want to do is, at first you start off giving it a risk-adjusted return according to every individual's own risk level. Of course, we take time horizon in there. We take risk level with questions, and then we take what's the money needed for, and at the same time, when do you need it? Which is a little time horizon, but it's also at the same time, what are the markets doing right now? So you got to look at all those scenarios. And I find as well, in coaching and talking to people about investments, a lot of people do start to panic a little if the market goes down a little too much. So we got to reinforce some of those attributes about longer term rebounds and everything else. But we also got to look at the full plan. A lot of times the investment side of a financial plan is a small part. There's a lot of things that go into it. There's life events, there's change of job, there's loss of jobs, there's getting an inheritance, there's getting a sudden cost to everything. Suddenly the roof needs to be replaced. You got to be ready for this and be invested properly. So that's why when you keep to that plan and you really assign a target time horizon and what the money is going to be used for, that's when clients start to feel better. We got different pools, emergency money, and we really got to coach them to follow that plan, because if you start, I want to go long term, the rates are too low, even though I need in 6 months, the market's doing well. No. The markets can change anytime as well. So you really got to coach them and help them and not sell. I had a client that was panicking during a correction that wanted to sell. So we took the index, the S&P 500, and then just monitored where he wanted to sell. And I kept him in long term. And next thing you know, we're looking at that index of where he wanted to sell, and the market was up 15% a year later. So, but he wanted to sell and go into cash, and rates were a little lower at that time. They would have lost out that 15%, and, long-term money for a short-term objective of being calm. So you really got to get a client in the right portfolio, and you really got to follow that plan.
Yeah, I agree. And I think what we're noticing, Ryan, you and I recently have been working with a few younger clients who have up until now worked with a robo-advisor platform, and we're not knocking robo-advisor platforms. They have their place in the industry. But the comment that we've received from a few of those clients when I've asked the question, why are you now considering moving from the robo-advisor to a managed portfolio? The one thing, the response from all of them has been advice. We're not receiving any advice. And you get what you pay for. They're not designed to provide you advice, right? So when the markets are performing in a certain way, good or bad, you're not getting any form of advice. They're not giving you any financial advice, retirement advice. It's literally, here's your questionnaire, here's your risk profile. Do you want to open up a TFSA, an RSP, non-reg? People open them up not really even understanding the difference between some of those accounts. And they're basically lacking the advice. So with the coaching side, Denis and even Ryan, you've said it, really it's behavior. That's the one thing that I think we've recognized and noticed with people, where their retirement plans or their investment plans, any plans that they put in place, can basically be destroyed in a matter of decisions made in minutes because of poor behavior, because of fear. Yeah. And that's where the benefit of speaking with someone who has experience, Denis and I in particular, we've been doing this since money was invented. We've seen a lot in the past, wars, you name it, terrorist attacks, all kinds of things, right? And they're all different triggers. They're all different reasons why there's panic, but the response, the process remains the same. And that's the one thing I do say to people is we don't focus or worry about things we can't control. Mm-hmm. All we do is we focus on the things that we can control.
Yeah, and sorry.
I was just going to say, and what we can control is, with some help, is the emotional side, right? The emotion of investing, the decision-making piece, and being able to reach out to an advisor to talk through that, and whether they're meeting your longer-term or shorter-term goals. To me, you just used a great example of, walking somebody back from the cliff to say, hey, this may not be the right decision because your longer-term goals are going to be met. And again, our brain's role within the psychology, it's becoming even more of a thing and importance when it comes to behavioral coaching. And again, we talk, I'm so fascinated. Jim and I were talking about this extensively yesterday, about the psychology of people and the psychology of how we make decisions, how we react to those decisions, and how our brain, prefrontal, limbic systems, all the hormones that are involved in those things too. We remove that because we want to be impartial. We want to take in the facts and understand at the same time your behavior when making the decision, and how investing is the market is simply based on the emotions of the people buying and selling and trading what's on the market, right? Mm-hmm. And by looking to and reaching out to a helping hand of an advisor that is truly helping you with the behaviors that potentially have been created over years, family, your own things that have happened within previous experiences with other advisors or other institutions, and allowing us to help provide some emotional discipline for you, and making sure that every decision is thought out, and that ultimately in the end, if you're working with that trusted advisor, you're getting and receiving some of that feedback to help you achieve your goal and your family goals or your business goals. So,
yeah, I wanted to add a little to that because a few years back, and it's the value of good advice that's important, because there's sometimes if you're not qualified, you don't have the experience, you may be giving advice that, can be questionable at times. What happened is
putting all your money in Bitcoin.
Yeah, I'm not a Bitcoin fan.
Yeah.
But what happened is a friend of mine's mother was invested. This is when just before Donald Trump got elected. And when he did get elected, he called all his clients and basically went into cash and conservative portfolios, whether you had a high risk or not. And when she told me that, I couldn't believe it. It was not based on economics. It was not based on anything but hyperbole that, everything's going to change and the world's going to end. Well, that ended up being one of the strongest markets we had in a while, and they were still in those cash-like type investments from a high risk. If you were in there before, then that's fine. But if you were not, that's when you took a big loss, and that's the advisor getting emotional without taking a step back first. Mm-hmm. So the value of advice is going to give you some of that percentage, Jim, you had mentioned, but it has to be good advice as well. It has to be somebody that not only has the experience, but looks at the full picture, not just a one incident. And us at Raintree, we will make comments all the time when there is an incident. When you mention wars, what are we doing different with the portfolios, if anything, what the client should do. And that's key. It calms a little the client. They hear it, they see it, and on video, because we do send videos. And then, okay, I'm okay with this. You gave a good explanation of why I should stay in the market. And sure enough, these things blow over. I don't want to talk about age, but over 30 years, I've seen a lot of up and down markets, and they always end up. It's a matter of just staying the course, and then you'll make money, because nobody could time the market. Nobody would be sitting here having a call if they could time the market, because they'd be making a fortune. But if you have the patience long term, even during the COVID crisis, some people, some of my clients invested money, borrowed to invest. It was selling at one point for panic selling. They end up 40% selling it a year and a half later, because it went down so much and it bounced back nicely. It's a matter of looking at the big picture and looking really at the details. Mm. Back to that good advice comment.
Yeah. And finally, on this point, we'll move on to the next segment. If you were someone who was investing in ETFs, robo-advisor platform, and you invested for 30 years, you were contributing, and you weren't ever looking at your statements, and you weren't looking at your account balances, you just left it for 30 years, and after 30 years, you finally decide to log in and see what your portfolio is worth, I think that person actually would do reasonably well, right? It's the fact that they're in every single day and they see movement one way or another. And when movement is up, they're buying more. And when movement is down, they're selling out and panicking. And that's the opposite way of making money, right? So if you're someone who can just hold on for 30 years, not take a look at your statement, you just keep contributing, you get an index, whatever, after 30 years, I think you'd be more than happy. But that's just not reality. And that's where I think the advice comes in. So let's talk about the next portion of that rate of return, which represents 1.13% per year out of the 3.52. And that's customized family wealth planning. So Denis, why don't you take over this one?
Well, a lot of that, again, everybody's different. So every plan will be different. So you really want to look at everything and all the goals and needs of the family. When you're doing your plan, you're not only looking at assets, you're looking at debt. Sometimes, you're not going to be investing. It's better off to pay this little higher interest rate debt first. So you really want to get that in place. There's also, of course, when you're doing a full financial plan, you're also talking insurance in case that money is not coming in anymore. Do you have disability? Do you have a critical illness? And finally, I know we're going to be a little short on time, so I do want to touch, as clients get older, they really want to know that's part of a financial plan, how their money is going to be distributed, how it's going to be taxed, who they should give it to, and how to do it. Does the spouse pay tax when they receive it? When does it pay tax? Does your RSP get cashed in if you're single? Who pays the tax on that? A lot of people have questions on that, and a lot of people have perceptions of what happens when they do pass away. So those are key questions. I even have questions. Well, I'm in a second relationship. My wife's in a second relationship. She wants to leave the house, the kids, but if she goes first, she doesn't want to kick me out. Well, what can she do to make sure that doesn't happen? You start talking about the life interest. You start talking to a couple, this is potentially what you need to add. with details, obviously. So I'm only looking at the high end. You want to leave a life interest to your spouse if you go first. When after that, it still goes to your kids after that. So it's a matter of getting some of those answers and having some of those questions. So as financial advisors, we have to ask a lot of questions as well to make sure they're going to get what they want, because sometimes a client just doesn't know, so that the question's not going to be asked. So that's key when you're doing a financial plan. And that's why I said sometimes the investments are a smaller part. Some lives are a little more complicated, whether they have a small business, they want to set up a trust. That's a little more complicated than somebody that's just leaving a couple, the RSP and TFSA. So you do have to get into some of those details. So that's why I think that wealth planning adds the most in some cases, depending on the complexity of the family.
Yeah, and Ryan, you and I have come by this situation on a couple occasions. Sorry, I got a little bit of a horse here. All righty, back on air. So how many times have we, again, sat with a client who did their own investing through robo-advisor platforms, and we look at their beneficiary designations, and we see that they've named their children under the age of 10 as beneficiaries on the RSPs. I'm not really truly understand, because again, when you're opening up the account through those platforms, it's just asking you, who do you want to name as beneficiary, right?
No.
So then we step in, and it's like this could have been a problem had we not stepped in and educated you on what would happen in that case and rectified the problem, right?
Yeah.
Or another big one too, pensions, defined benefit pension plans, which are wonderful, but it's amazing how people really don't understand that when you pass away as the person receiving the pension, there could be a survivor option, but then after that, the pension absorbs whatever's left over.
Yeah.
And we mentioned that to people, and they're like, well, I had no idea, and the way around it is potentially to take the commuted value. That might be an option, and structuring that in a similar way where it guarantees them income like a pension and still be able to do some legacy planning and leaving those assets to the next generation, right? So these are things that people just don't know. They're not given advice on these situations. The advice is, look at our fee. We have the lowest fees, and we have an app, and you can select all these different accounts, and you can track it. And that's really what they focus on, is just the fee, and not all this other planning that could potentially blow up their financial plan.
Well, as we go through this, and I was going to save this for the very end, but I can't, which is I look at the number of 3.52%, and again, lots of commercials throughout the sports events that are going on right now. Read the fine print. All I can say is we read the fine print, and I paused it to read some of the fine print on some of the companies and institutions that are currently marketing. Read the fine print. I know they're trying to attach themselves to younger generations right now about, your advisor, you're paying your advisor this amount, but the cost of not getting sound advice throughout is going to cost you a lot more. Bad word was about to come out. A lot more over the long term than anything. And, essentially what is it? It's a 1%. So you're paying the 1% to get no advice. You pay an extra percentage to get sound advice, right? And for those, if you want excellent advice, like here we are, 3 professionals. On top of that, the TVH group with the professionals that are helping on the estate, whether it's legal, whether it's accounting, whether it's mortgages, whether it's wealth, whether it's cash flow planning. There is a whole onslaught of things that this number, the 3.52, is just the median of the study that they found, right? And that's not including all the groups. And there's lots of great professionals out there that have great advice but there's very few that have teams that are helping you. So I just wanted to add that. So.
Yep. Well, why don't you take over the tax smart planning and investing, because that represents about 0.68% per year out of the 3.52. So how does that help someone's rate of return?
Well, I think you very much just started touching upon it, is really understanding how each of the accounts, how you can maximize tax advantage. You know, what does an RSP mean? What does a registered retirement savings plan mean? And what does that look like in retirement? Many will believe that you collect a lot of money into this, especially for people who have pensions. Just keep putting money in the RSP, but in the end, you will likely create a larger tax bill for yourself and pay more money in retirement in taxes. Let me repeat that. You will pay more money in taxes in retirement than you currently are. And that is for a majority of people that we're seeing that are coming through these robo-advisors or certain institutions. You know, what does it mean to use a tax-free savings account, TFSA? You know, the efficiencies of different asset classes and how they're placed. Denise just touched upon that. And you go, again, when it comes to capital gains and dividend paying. So all of this, when it comes to smart tax planning and how you invest your money at different stages of your life, and how you can potentially carry forward certain losses, or that there's planned losses. I know that's strange, but for a business owner, that is not. So, but it's a big world of information that one individual can't know, and that a team of planning out each stage of a life and every unique situation, because the robo-advisors and things like that are cookie cutter programs, very simple, easy programs that are doing the basics for, and they work for some and for periods of time, but over the longer term, you know, your collection of TFSAs or not using your RSPs correctly or not planning can really hinder how you keep your wealth at the very end. Now, if you love sharing your money with the government, by all means, give them more and more. But for a lot of clients that come to us is, how do I reduce my taxes? How do I make sure that more money goes to the next generation or charitable giving? So, and that doesn't happen currently with anything else. So, but again, it only makes up what was it? 0.66%?
0.68%. Yeah. On that
right?
one. Yeah.
Of the total advice. So,
and it's amazing. I love it when we present our findings using Planworth, our program, and people see that big red number flashing at them, and they always ask, "Hey, why is that number, $500,000 red in red?" Well, that's the tax bill. If you or you and your spouse pass away, and that's what you're going to pay or owe CRA on your registered accounts, being your RSPs and your liras. And it's amazing how a lot of people don't understand how or the impact of having that RIF or RSP when they pass away, and how it's all taxed and how that's all handled. So I do love presenting those findings, because people always ask, what's that big red number? Well, that's because you over contributed into your RSPs, and now you're going to owe the tax man. Right? It's a big number.
I think especially for families when the parents see that number, that's money not going to their next generation, like their kids or their grandchildren, right? And that's generationally. So we talk about this and getting sound advice. If you think about whether it's Warren Buffett, Robert Kiyosaki, Tony Robbins, you go on the list of all these millionaires and billionaires, what do they all have? They have a team of advisors, and they're happy to pay the 2+%. I'm probably sure they're probably paying 5 or 6% for the sound advice to make sure everything goes and that there's generational wealth for each and every one of their family members. So,
yeah. Well, you know what? Let's move on to the next one. Unless Denis, you have another point to make on that part.
Nope. I'll save it for the next one.
active rebalancing and asset allocation. This is your wheelhouse.
This is your wheelhouse.
Which is 0.28%. But yeah, let's talk about that, Denny. This is your area of expertise.
Yeah, well, in the portfolio management world and setting up model portfolios, we actually look at what's going on in the market and make sure that we are invested properly in the market. Are we in the interest rate increasing environment? Are we in a decreasing environment? Are equities strong? So we really do that first asset allocation. The asset allocation is going to be the driver of your performance on any account. And to be active is when it's key. And the good thing about portfolio management is we have access to alternatives. Basically, private credit that won't move similar to the market. We have absolute return funds. There's real estate as well. It's basically some of these managers, and it will be our decision how much percentage of the portfolio we allocate to them, but some of these managers do very well when the market's down. So this is where we make a decision on if we're seeing some correction in information like that, or at least have a protection in an unsure market of an allocation. These type of managers, they're going to help stabilize the portfolio. And what we want the client to have is, if they're, say, a conservative portfolio, we want to make sure that allocation is always set up that way. When the bonds are bad or equities are strong, what you want to do is rebalance, and that actually brings you back to you're taking profits. There's nothing wrong with taking profits. If you don't take profits and rebalance and put more in the fixed income side, at one point, that's going to start going down and you're going to lose that profit. So you want to rebalance to make sure that your portfolio is according to your risk level. And also, and I know an example in the Russell report that, somebody was probably a little more in the middle there on the balance side, but if you don't rebalance and the equity market's strong, you end up being a growth investor. And that's really not what you are. As I said before, nobody complains when the market's up, but sooner or later that's going to start coming down, and you want that protection, whether it's fixed income, private credit, or any of the alternatives, to protect when the market goes down. I know, and in some cases, having access, which is usually for the market exempt investors out there that only have access, but as an institution, we can give that as well, sort of an institutional managed portfolio. So that's going to be key. You want to rebalance, you want protection, and you want to be within your risk level.
Perfect. And then finally, there was a decline in that rate of return. So in 2022, it looks like the value of advice was 3.95. So last year it dropped to 3.52. I think part of the reason for that is people are more educated. They definitely do have more access to information now than they used to. So I definitely think there is more education. Investors are a little more educated. And I would attribute that decline to the fact that there is more information out there available to people. People they are smarter with their money because they've done their research. They may have contacted financial advisors to ask questions, but not necessarily work with them. And that's what I think attributes to that decline in value. What do you guys think?
Well, I agree. Part of it is education. And Jim, you and I have always said from the beginning, we want people to be more educated, right? And to be able to make some decisions on their own, but we want them to make educated decisions and not using, the TikTok video or whatever as the all source for everything, or somebody who's just not in the industry at all and just a game of telephone. Oh, did you hear what so-and-so did? And this is what they did. Well, that's unique to their situation. So for some people, they're less reactionary to, I think, obviously over the last few years, we've realized there's a lot of misinformation that's out there, and people are hopefully not as many people are reacting to some of that stuff, but instead they're educating themselves just a little bit more. And as you said, they're likely reaching out to a proper advisor And that's a great thing that people are being more educated, because
Mm.
financial literacy is something that you're going to hear a lot more of from us. So, yeah.
Yeah, I agree because now I think there's been some bad, some stories regarding what some of the banks are doing when it comes to targets. They're not selling this because this is the best thing for the client, but they have to do a check mark and hit their targets of selling so many TFSAs, so many deposits, and everything else. And people know that, and they're starting to question it, and everybody starts off with a Google search. TFSAs, all this. Some cases they'll find an answer they need and just move on, but some cases they need more than just a quick Google search advice. A lot of times when you do a Google search, you end up in the U.S. Okay, that's got to get rid of that. So you really got to find out what's going on now, and just question. You could be given good advice, but you just got to do your own education in the back. And when I sit down with clients, I do a little of the education process as well. I want them to do some research in the back if they're not sure, and then come back to me. Oh yes, I've seen that as well, because you don't get always the best advice just going to a bank or not necessarily a teller, but just somebody that's going to be there, and they probably won't be there next year. Uh, that's the problem I had when I was an advisor, but I was putting money in, starting within our ESP. Every time I went there, I sat down with somebody different, and they were asking me about when I do my own RSP. At that time, there was no robo advisors. I was in a discount brokerage and doing my own stuff, but you really got to pay attention to make sure that you're given the right information because it could cost you.
Yeah, and you and I both know as former bankers that if someone sold a mutual fund to a client that had more points or credit to the advisor at the bank to meet their targets than had they placed them in a 30-day T-bill fund, right, or
Mm-hmm.
a or a cash account or a GIC, right? So I do know when people make the comments of, well, you're on commission and you're charging a fee and you're only recommending because of that, and the bank doesn't do that. No, the banker has targets and they have to meet those targets. And if they don't meet those targets, they're not getting bonuses. They're not getting promoted as well. So don't fool yourself. The
Yeah.
difference is we have access to not only, so the banker only has access to the products available through the bank that they work with. And again, I know there have been times where I've worked with some of the banks where they might have a roster of products where they might have been really strong in one area in the marketplace, but very poor in something else. But you couldn't tell the client, you know what, take this here and go across the street to get this other product that, we don't really have a good one, but the competitor across the street has a very good one. We
Mm-hmm.
couldn't do that as bankers, right? So um,
Yeah.
yeah,
Yeah.
Well, as I said before, people who work for a bank are salaried, so they work for the bank.
yeah,
We, yes, are based on a fee, so we work for you.
mm,
And what value do we add to you? You know, there's lots of people that work on commissions. Real estate agents, financial advisors, things like that. So, what value do you add to your client to pay your bills? Because we're not salaried, right? At the end of the day, if I don't help you, you're going to go somewhere else,
mm,
and and that's what it comes down to, right? So, for anybody out there, you know, financial advisor, financial coach, whatever it is that you're using, what value, what connection are you getting tailored guidance? Is it not just a cookie cutter? Are you getting behavioral support through this? And I guess this kind of leads into our next thing of like the holistic approach that a really great advisor will offer you is is well beyond just simply cookie cutting and giving you, hey, this is what everybody else is doing, but instead looking at your unique situation to make sure that what happens now, today, and what happens in 10 years, and what happens in retirement and your legacy are all being met as it
mm.
changes. So,
Yeah, and we'll finish it off with the holistic approach, which is bottom line. If you're working with a strong financial professional, they will take a holistic approach to your situation to ensure that you're doing things right in all aspects of your financial plan. And I'll point out to us at TVH Group, we will look at your debt and make sure that you have the right type of debt through TVH mortgages. And you need some tax planning that's offered through TVH accounting. You need some legal advice or estate planning that's offered through TVH legal. Obviously, with Ryan and I, we help with the insurance piece and the retirement planning. Denis also as a financial planner, portfolio manager. We do it all in-house. We take a top-down approach. We look at everything from a holistic point of view, make sure that everything is working efficiently together, right? When people work with different financial professionals from different financial institutions, what they tend to create is what we refer to as a financial junk drawer, right? They have a whole bunch of different accounts. It's amazing how many people I'd have say to me, "Oh, I'm very well diversified. I have 20 mutual funds," and then we do the analysis, and like they're all pretty much invested in the same stocks and bonds. So you might have 20 mutual funds, but you're not well diversified. The holdings in those underlying funds are all the same or very similar, right? So the holistic approach is very important.
I agree. And in communication with the client and the advisor is also key. We need to constantly communicate. Anything changes. Are we on plan? What's next? Anything going to change in the future? And I regularly get all kinds of financial questions from my clients, which are, I've done it before, so it's a quick answer. That communication is key. I do not want a client that is not going to respond to email, not going to want to set up meetings. It's a waste of my time, and in the end, it's the waste of their time because I can't provide the advice, and the plan will, garbage in, garbage out. The plan will not be useful because we're not working together on it. So communication is key in setting up these plans.
Yeah, I mean, even in our engagement agreement with a client, we outline here's what they can expect from us as their financial professional, but here's what we expect from them as a client. And what we expect from them is quite simple. Just keep us informed. Provide us with the information that we need so we can do our job properly for them. Right? Mm-hmm. Help me help you, as the old Jerry Maguire saying goes. So on that note, guys, I think we've reached the end of this episode. Any last words? Any that you guys want to share? Are we good?
I'm good.
Yeah.
I think it was just, question, ask lots of questions, find out if you're getting the right advice, unique to your situation. And yeah, Jim, give them the details, how to get a hold of us just to have a chat.
tvhfinancial.ca, financial@tvhgroup.ca, 647-727-4668. Or you can look on our social media platforms and like and share and subscribe and do all those wonderful things as well. You can also sign up for our e-newsletter that we try to get out on a weekly basis. So you can also register for that on our TVH Financial website. So, guys, thank you very much. It looks like I survived this one, but I'm going to go take a nap shortly. So thanks, everyone, for watching and listening, and until the next time.
Take care.
Okay.
Why is it me? Why am I a guy? I still